computer. All right, good morning, everybody. Thank you so much for joining us today for our guest speaker series. We have Alex Dykes here with us with Intercoastal Mortgage, and he is going to be sharing some great information with us about refinancing and how that can help our past clients and possibly ourselves as well. So thank you so much for joining. Alex, take it away.
Yeah, thanks so much. Hey, everybody. Good morning. So, today's topic is refinances, and I'm sure all of you have heard 1,000 things about them recently, especially with the market that we're in and rates being the lowest that they've ever been. Like Jennifer said, my name is Alex Dykes. I am with Intercoastal Mortgage Company. The company itself is based out of Fairfax, Virginia, but I'm here in Roanoke. I branched out and moved down here about 2 years ago now to establish a Roanoke presence for the company, and it's just been fantastic since. I love living here. Everybody is super great to work with, so nothing but good experiences in leaving the DC Metro. So refinances in general, a little bit about the background about what you've probably been hearing. The mortgage market in general is built nationwide to do about $1 trillion in business a year. With the coronavirus and the federal rates moving down to zero, interest rates in the bond market and the mortgage market have just plummeted. There was a period there in midsummer that we were doing 30-year fixed refinances at 2.5%, which is like in the mortgage world for 30-year money, pretty much free, or as close as it gets. So what has happened is that over the last 9 months, we've crammed as an industry about $4 trillion into a system that was designed and built to do one. So it's been a little bit of a struggle, and I'm sure you guys have heard title companies talking about how busy they are, mortgage companies talking about how busy they are, and you guys have probably been really busy with purchases and listings. So that's just kind of the background in terms of where we are at this point. Now, the Federal Housing Authority Administration and HUD have announced, and I'm sure you've heard this as well, that a couple weeks ago they came out and said any refinance closing after September 1st was going to be subject to a 50 basis point penalty. And what they're trying to do, or what they say their intentions are, is to slow the market down for refinances, because the system, that was designed to do a quarter of what it's done year to date is just starting to struggle at all points. The problem with that is we're in time of a pandemic where saving money and refinancing for most people is really beneficial. So they're kind of, trying to accomplish one goal, but not taking into account the fact that they're really going to hurt the consumer by doing this. So since then, there's been a lot of pressure back to the Fed and the Federal Housing Authority from Congress and from mortgage bankers. So they've actually extended it now to December 1st. What that has meant, though, is that rates where we were, maybe say in June or July, have gone up slightly for refinances. They're back exactly where they still were for at those record lows for purchases. But now we're talking about a little bit of a delta between where we are for purchase rates and refinance rates. So that's kind of the overall state of the refinance market as it stands now. Also, please, let me open up the chat just in case. If anybody has any questions, please stop me and ask at any point. So the first topic I want to talk about are rate and term refinances, which is your standard traditional refinance. So they are perfect for people who have owned their home. Traditionally, you're looking at being in a house for at least a year, maybe 2 years before you're looking at refinancing. However, recently, with these historic drop in rates, even people that purchased less than 6 months ago are having really good success and savings with refinancing. So in general, what you're seeing the ability to do with a rate and term refinance is lowering your interest rate, your monthly payment, getting rid of mortgage insurance, switching from an FHA loan to a conventional loan as you build more equity in the house, or maybe your credit situation has changed since you closed on your purchase. But the primary thing is that you're hitting the reset button on your current mortgage. So we pay off the old loan and start a brand new loan on the house based off of the new amortization. So if you're going from a 30-year fixed and you're 2 years into it, and you're going to a new 30-year fixed loan, you now have another 30 years of payments. It is, however, sometimes beneficial for people to look at lowering their terms to a 20, 15, 10-year. It's really just a nice thing to do, to sit down and focus in on everybody's financial history every year or two as a lender. I try to do it with my clients every year or two just as a financial check-in. It's a great way to reconnect with my clients. And I often get leads from them just from talking to them and reaching out. But in general, the rule is that we want to be able to save a customer or a client over $100 a month in savings prior to actually proceeding with the refinance. Normally, the rate, we want to see a lower rate, but often resetting that amortization schedule, even if it's only a quarter of a point lower in rate, is really going to help people, because if they're in the higher loan amount. If they have a lower loan amount, you're looking at probably at least a point difference in your rate before you're going to see that $100 a month difference. So one of the biggest things I've seen this year is people switching from FHA to conventional. Roanoke buyers, there's a lot of Roanoke buyers, that, especially first-time buyers with the younger population here, that use FHA as a first-time home purchase, or USDA. Both are fantastic programs, first-time home buyers, but they both come with mortgage insurance in one way or another. So with the rising home values here, it's been a really, really good tool to be able to get people that would normally have to wait up to 5 years to be able to get good equity, to be able to get out of some of those government loans into conventional. We've been able to really accomplish that with a lot of buyers this year because we've had the rising equity in house prices, which has been really good. In general, appraisals on refinances, it's about a 50-50 chance right now with coronavirus if we get a appraisal waiver or not. So an appraisal waiver is we run every loan through our automated underwriting system up front. And what that does is it runs it through Fannie Mae and Freddie Mac's underwriting system, and it issues either an appraisal waiver or it doesn't. Appraisal waivers are great because if it accepts the house value as we need it to be to make the refinance work, the client does not have to pay for an appraisal. Right now we're getting about 50-50. Every other house that's getting one, which is just a great tool because, whenever you're talking to clients and, past clients especially about refinancing, everybody wants to know about closing costs, how to closing cost, how much am I going to have to pay? The nice thing is with that, we're getting a lot of loans where we don't have, that's $500 right there that they don't have to pay. And then traditionally, the way that I like to structure refinances is to roll all of those closing costs into the loan amount so that the client actually has to come to the table with $0, which benefits them because then they also get an escrow account balance back in cash after the refinance closes from their previous loan. So they often will walk away with lower rate, lower monthly payment, most likely no mortgage insurance or lower mortgage insurance, no money down, and often money back from their previous escrow account. So in this market where even now we're still in the high 2s, low 3s for rate and term refinances, it's a fantastic time for buyers to be able to save a lot of money. Now, the best thing about this is it's a great tool for realtors to offer their clients. So, I mentioned earlier that I use it as a tool to be able to do a financial checkup with my past clients every 1 to 2 years. But I've seen a lot of realtors using it as a way to be able to reach out to their past client list or their database and give simple information about the refinance market right now. You know, it'll be real. If you haven't done so already, I think you'll be really surprised at the turnout you get from past clients reaching out and saying, yeah, can you tell me more? Can you link me up with somebody that can help? Or saying, I know rates are really low. What's it look like to jump into a bigger house, or my next step in terms of buying a house? So, you may get one, two, three, maybe 10 leads that want to start looking at a new house because rates are so low. So when you're having that conversation, it's a nice service to be able to give to your clients as a check-in. But I think you'll actually, if you haven't done that or seen, and feel free to comment anybody that's done this, I think you'll see a lot of benefit in terms of leads turning back around into new purchases. So that's rate and term refinances. That's the normal straight one. Does anybody have any questions? No? Okay, great.
We're a talkative bunch today, Alex.
That's okay. I'm good at it. So the next thing I want to talk about is cash out refinances. So when you have rate and term, which means that you can have up to about $1,000 in cash back at closing, and what that can be is based off of like refunded items like the appraisal that you roll into the loan amount, etc. Rate and term means that you're not taking any cash out of the property for home equity. So cash out, however, is a great product for people that have more equity to be able to take out cash from the equity of their house for things like tuition, debt consolidation, home improvements, down payments on other homes. Maybe they are ready to take that step and move up to a bigger house, and they want to keep their current one as an investment property, get some rental income. They can always do a cash out refinance on it to be able to get enough money to, maybe it's the difference between making a 10% or 20% down payment. Or maybe it's the difference between being able to buy it all and get any down payment together to be able to purchase a new house. So it's a fantastic loan program. Rates for cash out refinances for primary residences are very minimally higher than rate and term. We're talking maybe a quarter of a point more. So when you're talking about being able to take out, let's say $50,000 out of your house in equity at 3.25%, it's kind of a no-brainer to me. You're not going to find $50,000 lent to you in any way that's going to be cheaper. Now, cash out refinances are all based off of, like all loans, but more importantly with cash out refinances are based off of the appraised value and equity in the home. So you're never going to get an appraisal waiver doing a cash out refinance. But that's okay, because with these increasing home values, we've actually gotten a lot more equity than we normally think on cash out refinances, which allows clients to take out more money. So it's based off of either doing a loan on 75% or 80% loan to value. When you're in the 75% or lower range, which means you've got a lot of equity in the house, maybe it's a client that's been there for 10 or 20 years, or put a larger down payment down in the beginning, you're going to get the best rates. So 75% and lower, you're going to be in that 3.25 range. No points, anything like that. And what we do is we take the delta from what they owe, and we set the new loan amount at 75% of the value of the house. And then we fund the rest as cash minus closing costs to them at closing. So, it's a great way for people, like I said, to get up to, I've done where people have gotten upwards of $300,000 back at closing. So, and the sky's the limit, but it's all based off of how much the house is worth. Now, when you reach that 80% equity, we can do 80% on any primary residence. However, the rates increase. So, instead of 3.25, you might be talking about 3.625. So, we're talking about increased rates. However, even given a year ago that we were in the 4.5 range, 5, it's still a phenomenal deal for people. Like this is a great tool to be able to reach out to people like your past clients, to be able to just once again, touch base with their financial strength and say, did you know that you could take out cash from your home to be able to, a lot of people just started college again, to be able to take out tuition, or to be able to, buy a boat or a vacation home, or whatever the case may be. I think the nice thing, so, the pandemic, from at least what I've seen, has done some cool things for the housing market in that, people are really hyper focused back on their houses and their homes and their living situations because everybody's at home. So, you're seeing a ton of people that are upgrading or to that second home, third home. A lot of older clients that are biting the bullet and deciding to go ahead and do their retirement home purchases now. I'm also seeing a lot of first-time home buyers, and traditionally, because rates are low, I'm seeing a lot of first-time home buyers that maybe wouldn't have qualified when rates were in that 5% range. People that would ride on the cusp of your debt to income ratios, people that maybe their credit wasn't as good as needed before, but we're able to get the credit up a little bit, and because rates are so low, we're able to make the payment work. So it's also a great time to be able to reach back out to those clients that maybe a purchase didn't work in the past, but with rates being low, and maybe there's been enough time for maybe a credit improvement or a debt improvement, it's always a good time to reach out to those past clients as well. We can do cash out refinances on any type of loan. So we can do cash out refinances on FHA loans and VA loans. So VA loans, you can actually take it with no penalty up to 90% loan to value. So VA clients are often able to get quite a bit more for their cash out refinances. I apologize. Any questions on cash out?
My one question on that is credit scores.
Mm-hmm.
Where do they have to be in order to qualify for that type of financing?
So right now, with the way that everything is written with the pandemic, at least at Intercoastal, I know other companies have non-qualified products and stuff like that. To do a traditional loan for anybody right now, we're looking at a 640 or better. Okay. Now, that being said, gosh, I have closed probably a third of my total loans this year for people who we've had to do a little bit of credit improvement up front on to be able to close. But right now, getting them from 600 to 640 could be as simple as paying $500 on a credit card. So it's really, really, if you have a client that's thinking that they can't qualify because they're a little bit lower in credit than they think they need to be, or they're below that 640 mark, just have them reach out to myself or another lender so that they can have that conversation, because it's so easy to get credit up for people to be able to qualify. They just have to take that step. The other thing I've seen a lot of recently are the credit repair companies. I'm sure you guys have heard of some of them or seen people with some of them. Credit repair companies, if you ever have a client talking to you about those, always be cautious. There are some that actually do really well, and there are some that are a little scammy. They make their business off of charging a monthly fee to the borrower for credit repair. So it's always in their interest for a credit repair to take a year instead of, what could probably actually be done in 5 days. Wow. It's pretty unfortunate that I've seen some unfortunate situations with those, but lenders are always going to be the ones that can give your clients the best advice in terms of getting their credit score up. So always have a client reach out to a lender directly before they reach out to a credit repair or any of those other companies.
Great. Thank you.
I did forget to mention something in the rate and term refinance, so I'm going to backtrack for just 1 second. If a client has a VA or an FHA loan, what they can actually do is what's called a streamline refinance, which is no appraisal and no credit qualifications. So they can it's a very seamless process. For VA, we literally have to get an updated pay stub to make sure they're still employed, do a VOE. We don't even pull a full credit report. We only pull mortgage only to make sure there's been no mortgage lates. and we push it through. We've done a ton of those recently that have been able to get, 2.375. VA rates are through the floor right now. They also have a lower funding fee for the streamline refinances than if you were doing a full purchase. FHA is very similar. FHA streamlines, they're super easy, limited documentation, often no appraisal. And like I said, rates for those are basically the same as VA. They're in the low twos right now. They're fantastic products for anybody that can't get that. A lot of people want to stay with the VA loan because maybe they did 100% financing. And then FHA loans, if you only put 3.5% down, you might not have that equity balance to be able to get to 100%, or to be able to get to 80% to get rid of mortgage insurance. So those are great products for people that are in those FHA or VA loans, may be a little bit nervous about taking that step into refinancing because they don't want to, they might think it's a lot of work. Those are so easy to do. It's so minimal effort on the borrower's part. So I wanted to touch base on those. I apologize, I forgot to do that just a minute ago.
Can I ask a question?
Yeah, please.
So the streamline refinance, is that only for FHA and VA loans?
There's also one.
Be a conventional as well.
No, there's also one for USDA, but conventional loans have to be either a rate and term or a cash out refinance. There's no streamlined process. However, refinances are very easy compared to purchases. There's no home inspection. There's no, most of the paperwork that we have to collect, we're talking probably 50 to 70% of the paperwork that we had to do with a purchase. So no tax returns normally. Normally it's just W-2s, pay stubs, and documentation about the house. Because if we're not having to pay anything at closing, we're not having to get asset information. So they're super, super easy. So while not called a streamline, and sometimes we have to do an appraisal, it's as close as a streamline that a conventional can get.
And if they're staying with the same company, are there still like the refinance charges? Are they still the same if they stay within the same company?
So for instance, there's a lot of benefits to staying with the same company in that, for instance, my clients, when they come back to me for refinances, I already have most of their documentation. So I have to get a few updated documents that are time sensitive, but otherwise I already have all that information to be able to plug into the system. They don't have to do a new loan application, et cetera, because I can pull all of that. The things that they're going to be, as far as fees go, our fees for refinances are the same as for purchases. It's $625 for underwriting and $625 for processing. That's all that we charge. And we do that for every loan. However, the things that change are the title fees. So the title company that I work with for most of my refinances, they charge $525 for their title fees, updates, recording, all of that. It's one set fee for refinances. And then you pay for the lender's title insurance, which is based on the loan amount. So it's a lot less than if you're doing a purchase. However, there are still fees associated with it.
Gotcha.
You also, the other piece to that, you also have to set up your new prepaid and escrow accounts. So you're collecting based off of, sometimes it's 2 months of home, taxes, sometimes it's 8. It just depends on where they lie in the year and where they lie in their tax bill or homeowner's insurance bill. But a lot of clients will actually choose to pay their prepaids as cash at closing because they know they're getting it back from the old lender. So it ends up being a wash in the end. Some people like to roll it in and then use that escrow balance to, maybe they need to get their house cleaned or gutters cleaned or paint done or something like that. So they'll use that cash to invest back into their house anyways. So it's a nice little treat at the end.
Right. And then my one other question, I'm sorry.
No, please ask as many as you like.
My other question is if we have a buyer that, is already currently using someone and they're unhappy and to kind of send them your way, what kind of sets you apart from whoever they might be currently using?
So, when I started my business, and thank you for asking that, it's always nice to be able to share that information. When I started in the mortgage business, and I worked for the vice president of Intercoastal at the time, and she was able to teach me that there's a lot of good lenders out there. There's a lot of people that can offer the same rate, but the thing that really distinguishes a mortgage isn't the rate. It's the customer service experience, and it's the experience that they have in terms of being, communication, closing on time, accuracy, all of those things that can sometimes fall through the cracks, especially when lenders get really busy with refinance volume. The things that I always promise my clients is they're going to get a ton of communication. I never want anybody to have to reach out to me because they don't know what's going on in their mortgage. They're going to get great customer service from start to finish. And, for instance, I'm always available. I never have an out of office on, even when I'm on vacation. I always try to answer people within 30 minutes to an hour of when they communicate with me, no matter what time it is, within reason, just to make sure that they know that I've seen their message and that, maybe I can't respond right now, but I will get back to them. Things like that really make all that difference. And when you're doing, mortgages are one of the biggest financial things that most people do, and they only do it once or twice in their life. So if you're able to if you're able to hold their hand through the whole process and really communicate and provide that excellent service, that's going to go way farther than maybe they got an 1/8% better rate with BB&T or a larger bank, yet they never hear from their loan officer. Their closing is late. Not to call out BB&T, it's just a good example of a big bank. Their closing is late because there's a lot of banks that are notorious for doing that. It's just, I don't know. It's like document requests, right? I hear from past clients, and I hear from clients all the time that their lender has asked multiple times for the same document. And that is so frustrating. And I would never want to be in that situation. So, our team asks for as many documents as we can at the start of a loan. And then we ask again after the underwriting has happened if we need anything else. And 9 times out of 10, we don't, because we make sure and put the time in up front to be able to make sure that the process is as easy as possible for the clients. So, long answer to a short question. I think the biggest thing is that I want my clients to walk away not only of a good impression of my team and a positive experience with the mortgage process, but also, especially when working with a realtor, I want them to make sure that the realtor, feeling good about the realtor's recommendation, because that goes even further when they refer friends or family to buy a new house, or tell their colleagues, hey, I just had the best home buying experience ever. So, I don't pay for leads. I'm not on Zillow. I don't do any of that stuff. Everything that I do is built from referrals, and it keeps me honest, and it keeps my team and their processes really sharp so that we can make sure and continue to capitalize on those referrals. So that's what we do. That's how it sets us. I think that's how my team is set apart from the rest of the industry.
Good answer.
Okay.
And talk to Ashley. She can definitely give you some input there as well.
Thank you. I think the other big thing too that I try, that I've had a lot of experience, a lot of the ways that I'm able to get a lot of my relationships started with realtors is that I'm able to I have a lot of flexibility, and a lot of that is both my team, but also the fact that when I moved down here, the reason I stayed with Intercoastal Mortgage and didn't jump to a, local lender, because we are now a local lender, is that Intercoastal has an incredible amount of flexibility in their loan portfolio. A lot of that has to do with the fact that the headquarters is in a bigger market, and, the competition with the volume of lenders up there originally was vast. So you have to. From a operations side, I'm able to get a lot more done quicker than a lot of other lenders here from my experience. And that's generally how I make my first introductions or first transaction experiences with new realtors. I'm able to step in where another lender failed or wasn't able to get it done and get it done for the client. So I think that's also another piece to the puzzle. All right. Any other questions? So I have one more topic to talk about, and I think it's really important right now. It's construction refinances. So I think you guys have probably heard you've heard many times throughout your career about cash out and rate and term refinances. However, construction refinances are a tool that are so important right now when we have limited volume or limited housing stock, excuse me. So, maybe you've had a client reach out that wanted to upgrade their house or move into, something bigger, something different location, different school district, whatever the case may be. But there's no houses available, which seems to be happening, I don't know, every other client at this point, or they have to wait, or they compete over and over and they get so frustrated because they're tired of competing for houses. Construction refinances very well could be the answer for that. Now, it's hard to tell realtors this sometimes because, when you have a purchase client, I would never want you to lose out on a commission. But we all know in the industry that sometimes pleasing the client is better than getting the commission because those referrals that come in later are going to outweigh anything we could have done for them. I think it happens for everybody. So construction refinances are great programs because it allows us to refinance a home and give money to be able to build additions, completely gut the house. Maybe it's a small house on but a great piece of land in a great location. We can tear the house down and build a brand new one. Maybe the client we don't do land loans, unfortunately. I wish we did. Retire in 2 years if we did land loans, but maybe they already own a piece of land or maybe they've inherited one. We can actually do a construction refinance on that because they already own the land to build a house. So you don't have to do the full boat construction process. So the way that they are structured is that what we do is we get all the plans and specs from a builder and for what work they want done. It could be as simple as, adding a sunroom or completely tearing down and building from scratch. But we base the loan off of the after appraised value. So we send all the plans and specs to the appraiser. They come out, inspect the property as is, and then they base the appraised amount as a subject to completion based off of the plans and specs. So, maybe it's a small house on a great piece of land in South Roanoke, great school district, but they just want a bigger house. They want to change, and the property is worth $120,000. Let's say they're going to tear it down and build from scratch. The appraiser will take all the plans and specs and the value of the property location, and then they will take they'll base the appraisal off of that. So you may end up with $550,000 appraised value. After we get that appraised value, we base the loan amount off of 80% of the appraised value. So let's say that it's that $550,000 loan amount, but it's only going to cost them $200,000 to tear the house down and build a brand new one. Well, because it's less than 80% of the loan value, they have to bring nothing to closing for a brand new house. If it exceeds that 80% of the appraised value, they pay for the delta only. So let's say it's 81%, right, for the cost of construction. Then they're only having to pay 1% of the total loan as actual cash to close. So it's a really good deal for a lot of people, especially in Roanoke, where we have a lot of really historic properties that need some love. We've got a lot of old old ranch homes that could either be add a second story, expanded, whatever it is to suit the client's need. It's a great art tool to be able to have in your back pocket, to have somebody talk about to a lender, to be able to, here's the thing, a lot of people, renovation and construction scares them. But the good news is that you have provided that information so you can explore that option and be able to feel better potentially about then the arduous home search right now. So it's just a fantastic tool to be able to have when you're in a market like this. The loan works in the fact that it's a 1-year construction arm. Rates on it right now are 4.25 and 1 point up front. The loan then converts over to what's called a takeout, which is your permanent financing after all of the work is done. So, let's say they build from scratch, they tear down the existing structure, build the new house. After that final inspection, actually about a month before they think the final inspection will take place for work completion, we'll go ahead and start a actual straight rate and term refinance on the property. As a takeout, they'll still have to bring no closing cost, no money to closing unless they want to. And then we'll put them in a 30-year fixed rate loan off of the construction loan. Your closing costs are going to be a little bit higher. We have things like a final inspection for the appraisal. We have to pay recording fees again, although I think it varies by locality. So sometimes, like Roanoke City, Roanoke County, Botetourt, et cetera, all have different rules about this. Some localities don't make you pay recording taxes again on construction loans. Some do. And in general, you're not going to pay full closing costs on the refinance takeout. They are reduced, and we reduce our fees as well on those because they're basically doing back-to-back loans with us. So, we'll try to, like, for instance, refund some of the point that they have to pay up, for their construction loan. So we try to make it so that the closing costs are as minimal as possible. But the great thing is you could potentially get a client into a brand new 100% theirs home, whether it's renovating or building a brand new one for no money out of pocket. And that's such a good thing to be able to help people with, to be able to talk about, and then when they're, everybody's back to work and they're in the office finally, and they're talking about, oh my God, what did you do during the pandemic? Well, we built a new house and, Andrea was helped us do it 100%. You have to talk to her. And then suddenly, it's how all the referrals work. So like I said, while, it's always hard to get, I always have to swallow referring out, business that's gonna, take a client from a nice commission for me to nothing, but it always comes back in 10 times because, it's the right thing to do sometimes. So anyways, it's a fantastic product to be able to refer out to people. People have been really interested in it lately. In fact, I had a client that was getting ready to close on a refinance today. Over the weekend, she sent me out of the blue a property that she was like, I'm going to go look at this. It's bigger. It's more what I want. Can we pause the refinance and maybe I'll buy this instead? I'm like, sure, great, go ahead. The property sold before she could even get in to look at it. But since, the conversation has led to the fact that we canceled her rate and term refinance, and she's going to do a construction refinance because she's not happy in her current home, but she can't find what she wants. So it's just a really great tool. So that is all that I have. Oh, one more thing. With construction refinances, they have to work with a Class A contractor. It can't be, my brother does great carpentry work, can he do the construction for us? If he's a Class A contractor, great. Otherwise, sorry, it has to be a Class A. And that's for both the client and the our protection, because we do everything in-house for construction loans. We manage the process from start to finish, including all draws, and order the inspections, order the title updates, etc. So that's really all that I have in the world of refinances. Is there anything that you've heard of that I didn't cover? Any other burning questions?
First, I'm going to say that last product sounds amazing, especially in this market right now, because the inventory is just so low. That is my main complaint is I really don't want a ranch. I would really like to have this, but I'm not finding what I need. So that
Yeah.
really would be a great option for some people. And you're right, referrals are everything in this business. And that just sounds like a really great product.
Well,
Really,
good.
yeah.
That carries over too to the fact that if you have a really well qualified buyer that's just not finding what they're looking for, and we're talking people with at least a 720 credit score and 20% down, you can also do a construction purchase loan where they acquire the land and build a brand new home. We do that in-house too. It works very similar in that it's a 1-year arm, same interest rate. And then at the end, we convert them with a refinance into a long-term, 30-year fixed, 20-year, 15, whatever they want. It works fantastic for both Roanoke and Roanoke City, as well as, the surrounding areas, but also Smith Mountain Lake, especially because there's so many great pieces of land down there. But the caveat is they have to build on it to be able to buy the land. We can't just do land.
Okay, that's a way around not just doing land. They have
to correct
too, so that's even better.
Yeah. The other two really good products that are not necessarily construction loans, and they're not great for refinances, so it's a little off topic, but in the same vein of being able to help maybe a client that hasn't, in a market like this where a client's probably struggling to find a home, we do have the FHA 203K loan, which I'm sure you've heard of, which is a great renovation loan. Or, Intercoastal has a product called a home style conventional renovation loan, which is a Fannie Mae product that's a conventional purchase that funds the cost of renovating a house. So our house that I'm sitting in now, we got for $110,000. It's on Day Avenue. It was a complete wreck. Plywood ceilings in some of the bedrooms. It was a mess, which, but because of benign neglect, it has all the original woodwork, bathroom fixtures, tubs, light fixtures. So it was great. So we actually used one of those renovation products to buy this house, and did a complete renovation from top to bottom, and the after improved value was $390,000. So total investment was about $290 to $300, and now we have $90,000 in equity from putting 5% down. So yet again, it's just another one of those good products that keeps me with Intercoastal, because we're able to offer stuff that's a little more creative than some of the small, just some of the other lenders out there.
So one question I had was about the rural development loans for clients that have those. That's what we actually did when we purchased our house.
Mm-hmm.
It was 100% financing, but there was no private mortgage insurance. So in the past, for refinancing, the rate was a little higher. In our case, the rate's a little higher, but what I was saving on a rate in the past was being made up by the private mortgage insurance.
Mm-hmm.
So in that case, would this time frame be a good time to explore refinancing because of the higher values in the homes and things like that, to get rid of the PMI?
If there was ever a time to do it, it would be now. And, I will caveat with, I'm always happy to run a scenario for somebody. All you have to do is send me your current rate, what you currently owe, and your address. That's all I need. I don't need an application. I don't need any of that other stuff to get a preliminary estimate done for anybody, any client.
Mm-hmm.
And it doesn't lock anybody in. It makes people feel better that I'm not asking for a lot of information up front in general, so they can at least get an idea. And yeah, I'm always happy to look at it if you want. And it,
very good.
Rates are as low as they have ever been and probably ever will be. So if you're ever going to get out of it without waiting, 10, 12 years for, true maybe 20% home equity, it's probably the best time to do it.
Does anybody else have any questions for Alex? No? We really appreciate you coming on and sharing with us today. It's always just a wealth of information, and I've only heard good things. I have not had a deal go through yet with Alex. He has talked to a couple of my clients, but I've only heard great things about him and Intercoastal. So definitely put him on your short list.
Well, Thank you, and I'm sure we'll turn one around very soon. Thanks, Alicia. I saw her comment. I love working with Wainwright Realtors too. You guys are awesome. I've never had a bad experience with anybody at Wainwright. So always appreciated. If you ever need anything, I think they put my contact information is in the chat box. And you can find, I only have one phone number, so you can text me, call me, email me whenever. I'm always around. So hopefully I'll be able to hear from you soon.
Thank you so much. And thank you guys for coming in today for the meeting. We really appreciate it.
Thank you.
Bye. Thanks, everybody.